we're seeing EPS, earnings per share, that came in stronger than expected at $2.59. Revenue was in line at $8.64 billion. But the big concern going forward is its guidance for Q4. The company has reduced it quite a bit, coming in much lower than anticipated at $1.63. The street was expecting $2.57 on Q4 revenue guidance. They are guiding at $7.2 billion. The street was expecting $9 billion. So there's a huge discrepancy in there. In the actual earnings report, there is a quote saying that industry demand has weakened and we are taking action to moderate our supply growth in fiscal 2023. So we could see much of the weakness. A lot of people are anticipating weakness in demand. We could argue it was priced in the stock, but this guidance that we're getting for Q4 is coming in much lower than anticipated, even with all the earnings revisions that we've received over the last week or so from analysts. So that is part of the reason why you're seeing the share price fall about 6% right now.
Yeah, Christina, that certainly is the reflex. Now this stock down already 40% or so from its high. So some of that was baked in, maybe not all. Let's bring in CNBC contributors Stephanie Link, the chief investment strategist at Hightower, and Greg Branch, Veritas financial managing partner, along with Eric to talk this out. Steph, first impressions of Micron. This is a classic story. Deep cyclical, complete bullwhip effect here when it gets to the end of a cycle, and you have a $1.8 billion revenue guidance shortfall relative to the consensus for the coming quarter. How does that play to you?
Yeah, well, so, Mike, we knew that PCs and smartphones have been decelerating and have been weak since the last quarter, so that was expected. On the other hand, they have cloud, data center, auto, industrial. That was supposed to make up for the weakness and the shortfalls on the other side, on PCs and smartphones. Obviously, a lot of things are starting to weaken. The environment is starting to weaken. The economy is starting to weaken. So I'm not too totally surprised. I actually have been very concerned about potential double ordering and triple ordering. I mean, look, if you go back, and this is a totally different industry, but if Target and Walmart can double and triple order, well, so can the semiconductors, and they've been known to do that. And so I think as the supply chains start to get fixed, then they're going to be left with a lot of excess inventory. So I'm not surprised. The stock is cheap. Even after you cut the numbers, the stock is still going to be cheap. But what do you pay for something that you just don't have a lot of visibility going forward?
Yeah, that's absolutely the question. And yeah, it came in under 6 times forecast earnings. Those forecasts are going to go down, but there's still a cushion. The stock even, coming up off the lows in the last few minutes anyway. Greg, just as a general matter, as we get ready for, the big rush of earnings right here, it is right at the front lines of the market debate, which is how much has the market already taken account of the fact that you might have more disappointing earnings than we've come used to in the last several quarters?
I don't think that the market is taking into account nearly enough, quite frankly. At the end of the day, if you do believe that we're going into recession, you believe that we're going to have earnings contraction this year on the S&P 500. I'm at negative single digit for now, which gives me about 195. Applying a 17 times multiple on that gets me around 3,300 on the S&P. And so we can't have this both ways. If you do believe that we're going into a recession, then you believe that there's going to be earnings contraction, and I don't believe that the market's reflecting that at this point. I do think that things will get more fierce in the near term. Analysts' estimates are little changed from the beginning of the year. And so there's a lot of catch-up work that's going to need to be done. Almost 20% of the S&P 500 at this point has either pre-announced that they wouldn't meet their earnings or missed, as we've seen today and in the last few days. And I think it's going to be more of the same, which is going to color sentiment.
But how is that not potentially a net positive, Greg, if you've already had a fifth of the S&P pre-announce or disappoint, and the market's been doing what it's been doing, implying that it doesn't feel as if earnings are going to hold up. Also, 195 for this calendar year for the S&P 500 when one quarter is already in the books. I think that means about a 20% shortfall relative to the final 3 quarters estimates. That's the kind of air pocket and profits you think we're going to see?
I do. And keep in mind, let's put that in context. Over the last 5 recessions, the average contraction's actually been about 30%. And so that would be in line in the back half of the year with what we normally see in a recession. Now, how do we put this in the context of, is it priced in? We know it's not priced in because the analyst estimates aren't reflecting that. And so I think it would be a little bit ambitious of us to expect that investors have priced it in if the analyst estimates aren't right yet, and they need to come down.